Good day. I'm Martin Gagel with Market Radius Research. It's Wednesday, April the 13th, and we've got Nick Blitterswyk of UGE International. UGE develops, owns, operates solar projects primarily in the US, but as well some other strategic markets globally. I'm happy to have UGE on today. I'm very interested in the solar space, and I'm hoping to understand from UGE how the development, funding, ownership, and operations of solar projects work and how they will benefit from that. There are at least three big trends in the solar space: declining costs for solar cells and panels, growing interest and demand for green energy from consumers, and growing interest from investors to fund green energy projects. I want to understand how these three trends impact UGE and how they are helping UGE drive growth. But please remember, this is neither a recommendation nor investment advice. We're here to learn about the company and the industry. So Nick, thank you very much for joining us today, and let's hear about UGE and the solar space.
Thank you so much, Martin. Great to see you, and looking forward to it. So just off the top, to touch on a few of those points. So like you said, we're in the solar industry, we're a solar developer. The solar industry is larger and larger every year. We focus on the mid-scale space. And so I think that probably a lot of your audience knows that solar is growing very quickly. The fastest growing subset within the solar industry in the US is the community solar space, which we'll talk about more. So we focus primarily on the community solar space. So fast growing company in a fast growing industry in the fastest growing segment of that industry. Number two is we'll talk about how we finance projects and the returns of those projects. But the business model that we've grown and put together over the years is very, what we would say, is equity light. We develop these projects and start generating cash from them even before they start operating. So we'll cover that as we go through the deck here. And then lastly is that across the company's history, which now stretches about 12 to 13 years, we have a ton of experience. So over 500 megawatts to date, which is right up there with any other solar company in this mid-scale kind of commercial community solar space in the industry. We'll talk a bit more about the evolution of the company as we go. But I think it's also one of the sort of opportunities for people taking a look at UGE to consider here is that we have all this experience. We pivoted the business model a couple of years ago so that instead of selling our assets and doing work for others, we started developing our own assets and building up our operating portfolio. So, as we've made that pivot, we have a very long, backlog pipeline sitting in front of us of projects to build out and own for the long term. And it's all going to be predicated by that experience that we have. So I won't go too much into the background here. Martin and I have known each other for, I think I first met Martin probably 6 years ago or something like that. And so, the company's been evolving, growing quickly. I think the one thing that stayed true throughout the entire life cycle here is this focus on the mid-market and seeing the good returns and the good growth and everything else that's available to us there. So solar, just, in a nutshell, again, probably something that a lot of people know, but just to sort of drive that home, solar has gotten cheaper and cheaper over time. This right here is from the 2020 Lazard study. Lazard puts out a levelized cost of energy study each year for different energy technologies. And on average, solar has become the cheapest source of energy worldwide. It's about 45% of all new energy being built in the US over the last 3 years. There was a Wall Street Journal article out, I think it was last week, that was talking about the amount invested in renewable energy last year topped fossil fuels and so on. So solar as a whole is very much here and now and becoming more and more so as the costs continue to come down the cost curve. The International Energy Association predicts that by 2030, solar will be 80% of all new energy that's being built worldwide. So in terms of the overall pie of where energy is going to come from, solar is really the dominant source of that energy. Now, community solar, we talk about that term a lot. It's an industry term, and I think to a lot of people, it sounds a little bit rinky-dinky even. But community solar, generally speaking, we're providing solar for anybody who wants it, whether that be a homeowner or a business or what have you, which is especially important because an estimate of about 70% of households and over 90% of businesses can't install solar on their own premise. So what we're doing with community solar is setting up systems that have like a community offtake, which means multiple people buying the energy from those systems. And if you actually compare it to like the addressable market of on-site energy, community solar is the much bigger bigger part of this mid-scale industry. It's very simple and affordable. We sell this clean energy cheaper than the grid, typically at a 10% discount. And like I said earlier, it's the fastest growing segment of the overall solar industry, with the Department of Energy coming out in recent months with about an 8x growth goal in the next 4 years, which would be the equivalent of about the entire history of the US residential market happening in the next 4 years. So it definitely feels like right place, right time for where we're at in this.
Nick, 70% of households can't install solar. And is that both a combination of local regulatory, like the city saying you can't do it, and then the power companies as well, sort of prohibiting that because it makes their energy trends, like they're not just selling you power, then they're buying it back and it gets kind of complicated. Is that the rationale for why you can't install solar?
Yeah, I think yes, but the bigger piece that you didn't mention is people that don't own their own homes as well, right? Or because they rent their home or they rent their apartment or what have you. Like where I'm based, I have a lot of tree coverage. I would love to have solar on my house, but I have shade on my house most of the time, and it doesn't make a lot of economic sense to do so. So I think there's a bunch of these different types of issues, and when you go to businesses, it kind of links with another point too, but over 90% of businesses don't even own the premise that they're in, right? Those buildings are owned by a REIT or what have you, or they're in an office building and so on. So the actual share of homes and businesses that can't install solar themselves is the vast majority.
And maybe you're going to address this shortly, but is the premise that then you develop a small solar project on the roof of some warehouse or in some field that's close by, and you're not actually getting the exact electrons that your solar panels produce, but they're sort of, you sell them into a grid or an offtake, and then I get sort of a credit for an economic credit for the electrons you sell, which then I can use to buy my own electrons, so to speak?
Yeah, no, very well said. So this picture we're looking at right now, this was the first community solar project in Maine, which we did. This was a smaller one than we would typically do. This one feeds about 15 homes in a town called Monson in Maine. So we were the first ones in Maine and also the first ones in New York City doing these types of community solar projects. So the 15 or so people that subscribe to the electrons, if you will, from this system in particular, what they're doing is they're getting credits, and they apply those credits against their bill. It's almost like buying a gift certificate. So they don't have a direct line to the system. It's more a matter of a crediting mechanism.
Okay. All right.
Yeah. No, and you get it, and kind of provides a good segue here to the next slide. Just zooming out across the country, there's a few aspects. So like number one is this like benefit to all stakeholders. So the other side of this equation in terms of like where we put the projects, Martin, you mentioned a warehouse there. So if you think about like a massive warehouse, a distribution center for Amazon or Walmart or whatever the case may be, they typically have a lot more roof space than they have energy need. And in many cases, that building might be owned by a REIT and Amazon's renting it. And so there's like a difference between those two parties as well. What community solar has allowed us to do is to back up and just go straight to the real estate and say, hey, we'll pay you, say, $200,000 a year to rent your rooftop. We put solar on that rooftop, and then we sell the credits from this system to other off-takers. And so it's taken the C&I, or like commercial industrial solar space, which was always a bit niche based on just how many buildings are not owned by their tenants, and really allowed it to explode based on us being able to just offer it to any real estate owner and then get this clear benefit in terms of lease payments.
And I'm guessing like 5 or 10 years ago, like deals like that were never contemplated in lease contracts. So you'd go to them and say, hey, we want to rent the roof. Who has the rights to the roof? Is it the guy renting the building, but he doesn't want to invest in it because it's a rental, but the property owner doesn't have the right because someone else is leasing the building? Is that part of the equation?
Yeah, that's exactly what we used to run into. So, probably, mid last decade, let's say when I was first meeting yourself, Martin, at that point in time, C&I solar, it would be like, hey, we're going to offer a power purchase agreement. You're going to save 10 or 20% off your grid. Isn't this great? And the economics sounded perfect. but there was only so many owner-occupied buildings. There's only so many like big, IKEAs or what have you that own their own real estate and so on. So with community solar, what we do instead is we just look to the real estate owner regardless, go straight to, we haven't announced the name of it yet, but there's a large REIT we're working with. We have an 81 site LOI that we're working with, and just say, hey, we'll pay you $1 a square foot for space on your rooftop, for example, and we're going to build out these solar systems across your portfolio.
All right.
So very much simplifies it. Yeah, yeah. And on this map here, this is our own grades of community solar across the country. Myself, I'm from Western Canada, but I was in New York City when I started the company. So the Northeast was always sort of our hotbed. And so community solar started picking up right around us. And we were, again, kind of right place, right time. We've been expanding throughout the Northeast in particular over the last couple of years here. Last year, there was 22 states that passed some level of forward legislation in support of community solar. So we're seeing the number of states allowing it growing pretty quickly here and expecting it to continue to pick up in the years to come. Like, for example, California, one of the kind of holy grail states, it has a program, but it has such a low grade right now, it just is not very efficient. So we're helping lobby to get that updated as well. So we expect that by 2025, the majority of states will have community solar, so far 75% actually of all community solar has been in just 4 states: Minnesota, New York, Florida, and one other that's escaping me. So there's just so much room for growth in this industry as we go forward here.
The fact that you have to lobby governments to allow this, does that sort of indicate that the power companies are pushing back against it because it kind of makes their grids more complicated, and then they've got a bunch of different suppliers and they're trying to have more control and maybe build out their own solar? Or are you kind of opposing the power distribution companies a bit there?
It's a good question. I think it's on the back of, overall in the background, there's been this huge move of deregulation for the energy market, right? And really the utilities, more and more, especially in more kind of heavily deregulated states, those utilities are more like the pipes and they're not necessarily the generation. So in a lot of cases, like actually working with the utility to install solar can be slow. There's a monopolistic nature to them, but in many cases, they're neither for nor against it. We had an interesting case, which is going a little bit of a tangent here, but in Maine, there was so much growth in community solar, the regulations actually pulled back the max size of projects there. 6 of the projects that we had above the kind of old cap or the new cap, 5 of them were with one utility that publicly supported us in having the larger cap. One was with another utility that was very aggressive against it. But I think the broader picture is that this deregulation allowing energy supply from different markets. Some of the viewers might be aware of, Just Energy, Creus. There's been a few names in the the Canadian market that have offered like retail energy supply and so on. It's more like that we're kind of piggybacking on those same types of regulations to say, hey, we're an independent power producer. We're producing systems of this type and selling the energy to people that offtake it. In theory, the utility is still getting paid for the transmission and so on that goes behind the scenes there.
All right.
Yeah, and then this actually provides a good segue to the next slide. But there is I'd say it's your far greater round trip efficiency. But I'll just go to the next slide to talk about that. So UGE, the way that we approach this industry is that we're like a full life cycle shop. So we originate, develop our projects, we project manage the build out, we finance them, and own and operate them. This is the first 5 years of the company's history was us honing the skills as a developer and a solutions provider for the commercial space. In 2016, we acquired a company that was very good on engineering and building these projects. We put those two things together, and then over the last few years, we developed the expertise to finance and now own and operate our projects as well. Within our industry, we're primarily up against companies that are developers. Sometimes they might develop and build or what have you, but these 4 pieces along the bottom, very rare you see it in one shop. So we've seen ourselves come together to be able to provide that full life cycle really in about 2020. And we've seen our growth really explode since then. So, in terms of the greater returns we're getting to shareholders by bringing this all in one house, a great deal more efficiency. If I use that REIT that I was talking about earlier with the 81 site LOI, in that case, it allows us to just to move through a portfolio, work on a couple projects, work on the next ones, and they don't need to worry about that project being sold off or what have you in the meantime, which we had seen kind of in our previous life that we used to sell these projects as just being a great deal inefficient as we went through the process here. So, all in all, that's really our hypothesis, is that in this mid-scale space, bringing it all together allows you to be that much more efficient.
When you're dealing with one of these REIT, is it typically you're just paying rent, or do they want to participate in some of the like some kind of a revenue share and like have a slice of the revenues off it? Or just as a REIT, they're like, give us $1 a foot or whatever it is, and that's how we operate?
It's primarily the dollar. Yeah, like that's how we operate. It's like
Okay.
in New York, they might have a 25x cap factor or something like that, right? It's like we offered them $200,000 a year. Well, we just increased the value of that building by $5 million. So it's primarily the rental income. We've looked a little bit before at a little bit more of like a royalty model or what have you, but at the end of the day, it's always come down to just a flat lease. And just in terms of the benefits there again of how this model comes together. So we'll go through a couple examples later, but I'll just say it again that it's a very equity light model, even though it's like a capex heavy model, right? So we're the owner of these assets. We're building out these mini power plants. From an equity perspective, because the returns are high enough, we're fully capitalizing these projects with with third party like non-recourse debt, and then the investment tax credit that's available in the US. So from an equity perspective, we are actually capturing what we call a developer fee as we build out these projects, and then positive cash flows from the projects as they go onward from there as well. We just talked about the efficient client delivery, about us being the full life cycle shop. It's one of the main reasons that we went down the route of financing our projects ourselves, was because of the inefficiencies that we kept seeing in the model of develop, build, and own operate being three different parties. And then lastly is that these are very long-term returns. So our average contract starts with a 25-year base, and typically would have like say 3-5-year extensions. So these are 25 to 40-year assets, and all sitting there in front of us. So if you compare that to the average life cycles on like the kind of the main Canadian renewable IPPs you see out there, the average lifespan that we have in front of us compares very favorably as well.
And so when you do a lease with a REIT, it's a 25-year lease with a bunch of 5-year renewals on it. So what the space you're leasing matches the asset life?
Exactly. Yeah. Typically on that, like a program, community solar, you might be grandfathered into like, this is what the framework looks like for community solar in say Maine. And let's say that it's 25 years. We'll get those options to extend thereafter. The landowner is more than happy to have those. And it's just sort of, for us, it's a question about what's the policy landscape going to be at that time.
Yeah. All right.
Yeah. So there's been a huge aspect of growth for us in the last couple of years here. This coincides very well to the pivot that we made to kind of completing the full life cycle, holding on to the assets ourselves, and stopping doing third-party EPC work, which was a big part of our revenue pre-2020 of, in essence, building projects for other developers. So we made that pivot and started 2020 with I think somewhere in the range of 15 megawatts of what we call our backlog. As of right now, we're close to 150 megawatts of backlog, and looking to be adding about 100 megawatts per year. All just in terms of like what that means, I'll actually go to the next slide. As we've been growing and evolving, we've started to talk more about and break down in more granularity the overall funnel, the overall development pipeline that we have. So this right here breaks down the different stages that we have as of March 31st. So we had a bit over 1,000 megawatts of pipeline work. So we had put out proposals, we're negotiating terms, etc. but we hadn't yet signed a contract yet. About 190 megawatts of site control. So we have a lease, or we have space where we can build a project. We've typically filed for interconnection, but it doesn't yet pass a threshold. And that threshold is management generally believes that this project is kind of got the major red flags out of the way, so that it's going to proceed to becoming an operating asset. In our MD&A, yeah.
You talked that you have site control. Is that essentially like, but you don't own it yet? It's not officially in the backlog. Does that mean you essentially have an option on it? You know, if you get the rest of the elements in, it's yours to do what you want, but the other pieces may not fall into place. Is that what you mean by that?
That's exactly right. Yeah, okay.
Yeah.
A common example might be, some states, it's hard to know about the interconnection capacity of like the transmission lines nearby or what have you. So we might have site control and option to lease, but we're going to file for interconnection and at least get past that first stage to understand what the cost of upgrading transmission, if that needs to be upgraded, or whatever the case may be. So there's just a few questions we have at that stage. And the way that it typically works for us, if I mentioned before, let's say it's going to be a $200,000 lease, typically we'll have like let's say a 12-month free look or something like that. Or maybe instead of 200,000, we're paying it's usually like a 5 or 10% of that for the first 3 years or something like that through the development period. So it's that earlier stage of development where we're answering for ourselves some of those questions.
All right. And do you have any statistics on like roughly your pipeline of like 1,000 megawatts? Like, is it like 20% then fall into site control and then 60% fall into project development? Like, there is some risk that they fall out of it. Any like broad statistics on like how many go from one step to the next?
Yeah. So in past the pipeline stage, we saw about 33% drop into the project development stage. So we're kind of jumping over stage 3.0, but that's roughly what we've seen, about a third.
Okay.
Yeah, and then once they're in these categories that we talk about as project backlog, there's definitely variability within development. Some projects might not become viable, or more commonly, the size of a project might vary. But that's in like the 90% range across the backlog, where we're pretty confident that those projects are going to go through. Now, again, like in Maine, they retroactively changed the size of some projects, and we lost some megawatts. That variation can happen. But on a gross level, that's how we see those you know what I'm saying?
Yeah. And so the operating assets, so you now have had 2 megawatts fall or go through the entire development process and are now producing assets for you.
Yeah, that's right. Yeah, and last year, roughly speaking, our renewable energy, like our recurring revenue from energy sales increased by about 10x. So it's in the early stage of that growth. As we speak right now, we're within a few months of completing 3 additional projects, which will almost double our operating capacity. And then we have another 10.7 megawatts, which are anywhere from weeks to months away from what we call notice to proceed, which is when it's cleared for construction. So we're going to see that operating asset base scale exponentially in the next year, but continue to scale exponentially as this development pipeline flows through.
Right.
Good. So we talked there about the pipeline and shape of that. We talk in a few slides. We talk about the EBITDA goals and so on of the portfolio as it scales. One of the other things that we like to allude to is, like, as these projects are making it through those stages, they're growing in value, and we get to this kind of net retained value number, as we call it, in terms of like the present value of those net cash flows to UGE. So this is one example from our portfolio. This is a New York City project where it comes out to about 80 cents a watt as a proxy for the type of value that we expect to get on average from that development pipeline that we were talking about earlier. So I think if you just flip back here for a moment, the 141 plus 3, like this kind of more later stage backlog, you apply that 80 cents a watt type of number to it. And if I do my math on the fly here correctly, we're talking about 110, 115 million USD of net value that we expect to get out of just the backlog, never mind the pipeline that's behind that, as those projects are built out. So, we definitely feel that there's a lot of value, of course, being created here.
When you say net value, you're not talking, that isn't an annual cash flow amount. That's sort of the NPV of the future cash flow.
That's right. Yeah. And actually, I think that if I flip to a couple examples we have in here real quick, the way to think about it, so the graph in the bottom left, the dark blue line called operating cash flow. So it's really a net present value of those net cash flows. And so one of the things we talked about is it being an equity light business model. If you combine a couple things here, I think I was trying to find the cursor. I'm not sure where it is, but anyway, if you combine a couple things, from a cash flow perspective, as we start to build out these projects, because we are the developer, because we are the builder of these projects, we're capturing net cash flows from that, which we generally refer to as a development fee or a development and EPC fee. And so, from that perspective, our cash flow actually comes quite a bit before the income statement gains. And so, the next 12 months of our growth here is quite exciting as we see more and more projects make it into construction and then from there into operation. So, yeah, and I mentioned it earlier, but this project here, if you look in the bottom right, has an unlevered after-tax IRR of 17.6%. So across like the full life cycle, that's that one. Rooftop projects tend to be a bit smaller, but a bit higher. The second example that we have in here is a ground mount project. That one's about a 15% post-tax unlevered IRR. So, you compare this to, say, utility scale solar, what have you, those are very strong returns.
When you say that you make revenues and profit off of the development stage, but you're also the owner, like you can't be charging yourself sort of fees and calling that revenue. Are these projects structured in like they're a special purpose vehicle and you're a part owner of it, and then you charge that project some fees, which you sort of count as revenues in?
So so good question. So a couple of main things is that the cash flow side of things and the income statement side of things are a bit different. So UGE maintains control of these SPVs. So each project's in an SPV. So UGE maintains control. It's all part of our consolidated financials. So from an income statement perspective, say if it's a 25-year asset, the green line in this bottom left chart is fairly flat. And in fact, the only reason that it's a bit lower in the first year is because this project is, I think, scheduled to go online in May of this year. So it's not a full calendar year in the first year. So from an income statement perspective, it's fairly flat. But then on the intercompany side of things, in essence, if you look at the sources and uses in the top right here, what we're doing is that the returns are high enough that the way we fund these projects is we have banking partners that provide the permanent non-recourse long-term debt for these projects. And then there's also the investment tax credit. So if you put those two things together, it is higher than our actual third-party costs. And so the difference there is cash flow to us, but it's not accounting income to us, if that makes sense.
Gotcha. And when you say it's non-recourse, that the funder is putting money into the SPV, and let's say if something would go haywire with the project, the lender would then sort of seize that solar project's asset. They wouldn't go after UGE itself. You'd lose the project, but not UGE itself, so to speak.
Exactly. Yeah, okay. That's right. Yeah. Yeah, and so I think that gives a good sense in terms of these projects here. And of course UGE in the top left here, right? We're the quarterback that's bringing this all together and realizing the long-term returns. Yeah. We've talked everything so far we've talked about has been solar, and I have one slide in here just to talk about energy storage because it's becoming a more and more important aspect of the industry that we work in here. Battery storage, if we had a cost curve in here, it would look pretty similar to that solar cost curve that we saw earlier. We had in 2014 or 2015, battery storage was starting to be talked about more often. And I bring up that time frame because at that point in time, we formed and announced a partnership with Samsung, and this was something that we had looked to get off the ground a bit at that time. At that time, battery storage was north of $1,000 per kilowatt hour. Now it's like 160 to 170 per kilowatt hour. So battery storage has taken a while for it to get off the ground, but it's really starting to take off in a big way. And I think witnessed by ourselves in November of last year, we announced expansion into Massachusetts. And in doing so, we announced over 100 megawatts of commitments in the state. And all of those projects have battery storage, either standalone or solar plus battery storage. So it's something we're getting increasingly excited about. In New York, Con Ed, we're in Con Ed territory. We're just wrapping up some solar plus battery storage projects now. But upstate New York, like outside of Con Edison territory, nowadays projects we're developing, we're doing so with solar plus battery storage as well. So an exciting kind of additional growth lever for us. Roughly speaking, if you're talking about, say, a 2 megawatt solar project versus a 2 megawatt battery storage project, on average, we're talking about similar value for each of those two things. Battery storage actually even a little bit better right now than the solar side of things. We could probably spend, an hour or two just talking about this, but on the bottom right-hand side, just at a high level in terms of how this works, is there's different revenue drivers for having battery storage. In Massachusetts, there's a big push to, in essence, store energy in batteries at the times where the grid is under the most strain, and then put it back into the grid at the times where, I'm saying it opposite, but taking energy when it's most plentiful and using it when the grid is under the most stress, and that's called the clean peak standard, because it's generally looking to offset like peaker plants, which are very expensive and very polluting in the state of Massachusetts. So an exciting growth lever for us as well.
Is the economic, do they like you store it, and the economic benefit for storing it is that you get paid a higher rate during peak hours, or is there some kind of a government incentive to, okay, we want you to store it in a clean manner, so we'll give you credit for that, so we don't have to fire up the peaker plants during a hot summer midday when everyone's flipped their AC on?
It's a bit of both. The most simplistic way to think about it, like the way that it boils down, is in essence charging up the batteries, which could be directly from solar, or it could be from the grid at times where there's a lot of energy available in the grid. Charging up those batteries when energy is cheap, and then putting energy back into the grid when energy is expensive, and capturing that arbitrage. The reasons that the grid could be expensive or cheap are more nuanced than might be expected. Like, for example, in this chart, you see things like, for example, like frequency regulation. It's providing services to the grid to help modulate the frequency of the grid to, in essence, make it to make it operate more efficiently. Or the clean peak is there's expensive energy to push your battery's energy into the grid at times where, if you don't do that, peaker plants are going to need to come online, which is expensive, and so on. So it's kind of a combination of those different drivers.
Gotcha. With the decline, like the learning curve on solar, that's been going down. It's not so commodity price driven. There's been a lot of news recently of lithium prices going sky high. Are you seeing that impacting the prices of batteries, and then as well the economics for the ESS?
I'd say that the availability of batteries has been the bigger thing. Like, delivery times getting longer for sure. Like, I think right now in April of 2022, for a battery project, you're looking at any sort of scale, you're looking at 2023 delivery for the battery side of things. So I think the pricing, and this goes for solar panels as well for the most part, it's like, hey, with supply chain constraints, we haven't seen the decrease in solar panel prices that we had been seeing in prior years. but the level of increase has been, for the most part, pretty mooted. It's more a matter of like, instead of 6 suppliers having supply ready for you, you're finding the one that can meet your time frame. So it's definitely a constrained environment, but it's not something that, it's not something that we're seeing cost necessarily skyrocket, as long as you can be a bit patient and plan out your projects accordingly.
So the big impact is it's delaying things. It's forcing you to be a little more organized and order ahead and plan better.
Yeah, I think organized is the way to put it. Like, for our Massachusetts battery storage projects, based on the time that it will take to go through interconnection approvals and so on, we're not expecting to build those till 2023 anyway. So the fact that those batteries aren't available in 2022 isn't necessarily a constraint for us.
Right.
Yeah. So kind of rolling this up and thinking about where we go from here then. So we have these 2024 goals we put out pretty much exactly this time last year. So that was to get to 100 megawatts of operating assets and also be adding 100 megawatts per year by that point in time. And so, one thing that we're excited for is that last year we were ahead of target in terms of our growth in our project pipeline, and so we're very much on pace to hit these targets for 2024. So excited to get there. I will say that internally we call this base camp. 100 megawatts of operating assets is not the end goal. It's sort of like entry to whatever, going from high school to university or whatever the case may be. For us, it's just another step in the ladder, but one that we're excited to get to. And I mentioned off the top, but the company, we have over 500 megawatts of experience. Like, this is something that internally, it's just focused on execution, heads down, make it happen. But I think that in the public markets, I think this is one of the sort of maybe discounts that maybe UGE trades at, is based on our operating portfolio right now is so low because we made that pivot. And I think there's a bit of maybe a wait and see in terms of how quickly we bring these operating assets through the development stages here.
Right.
I'll just say that, earlier we talked about the 80-cent measure. So each megawatt provides in the bottom right. So we talked about this net retained value measure. We provide a much wider range here, but, suffice it to say 100 megawatts operating assets would be about 50 to 100 million of present value of that net retained measure, and then adding that again on a yearly basis. So last year for our backlog, we added just about 100 megawatts of development last year. So we feel very much like we're on track for both those goals. And in fact, as you see in the bottom left there, we have about 334 megawatts in various stages of development right now. So in terms of the public market side of things, so we're traded on the TSXV. Plans to uplist to the main board within the next 12 months. So we're excited for that. We do trade on the OTCQB in the US as well. In no particular order, I'll say that there's still very strong management insider ownership of about 40% in total. Myself and my, broadly speaking, the initial co-founders, we own about 32%. And kind of for the second time, we re-upped a 3-year hold on our shares. We're all very supportive of the company and frequent buyers of stock in the company, and we have it documented that we won't sell a single share now through, I think it's maybe end of May 2025. So very supportive of the company. Market cap right now fully diluted in the 38 million CAD range. And you see the chart here on the right. So, the first half of the chart or so is when we were coming out of our turnaround, when we pivoted to owning our own assets. There was quite a nice run up, of course, of solar stocks at the end of 2020 into early 2021. And we've been trading fairly sideways for a while. And then just since April 1st, there was a good amount of volume to the downside. And we frankly don't know exactly what that was. We did put out our Q1 milestones, which we had lost some megawatts in Maine, as we talked about, but there's a lot of other really good things going on too. So we'll continue to work at that as well. On the financial highlights side, I'll just say our year ends are coming out in the week after next. So next week we'll have a press release announcing the webinar for that. So this is for the first 9 months of last year. I won't go into too much detail here, except we had done a lot of work a year and a half ago, cleaning up the balance sheet and feeling good about how that stands. And then also the recurring revenue is really starting to scale up, at least from a percentage perspective. And we'll see that scale up quite a bit over the next several years as this, as these projects in development continue to find their way through the funnel. There's 5 analysts that cover the stock. So listed here, average price target is almost 4x where we're trading right now. So all of these targets were reaffirmed after last week's Q1 milestones. I'm sure these analysts would probably love to hear from anybody with any questions there. And then just a few recent updates. We largely talked about this as we went through the presentation, but the second half of last year, there were several announcements, like, for example, an 81-site LOI with a REIT that we're working on, and the first projects from that are expected to go into that backlog stage in this quarter, Q2. The Massachusetts expansion with over 100 megawatts of initial commitment, so we're expecting that to be a good state for us going forward. And then, everything we've been talking about has been our own organic development, but we do have this very efficient platform, and there's a lot of small developers in our space which are developing projects and selling them. So we made our first, we signed an agreement to make our first acquisition for 2 rooftop projects in Arizona, and see that as being a nice bolt-on opportunity for us to pick up other accretive assets as we continue to scale up our portfolio here. We also signed really nice offtake agreements with Bloomberg and T-Mobile in the latter part of last year. So just, I think, adding further credibility to our business model and the type of company that we keep. And then in terms of regulatory support and so on, I mentioned earlier, there were 22 states that passed some level of legislation allowing community solar last year. And then also, we just actually on Friday closed our most recent green bond issuance, which this was our third that we've done over the last few years. Yeah, we thought it was, for us, quite a good use of capital and a good fit with what our investors were looking for. It provides us a good non-dilutive or very low dilutive source of capital for as we scale up the business here. So I know there's a couple of those slides just with some of the highlights we covered, but I think, Martin, that pretty much covers it.
All right, I have a couple of questions here, and then we have several from the audience here we'll get to very shortly. You mentioned you have offtakes with Bloomberg and T-Mobile. Could you just generally talk about how you structure offtake agreements, or do you are they like fixed rate offtake agreements, or are they kind of relative to the market price at a discount or premium to that? Yeah, just sort of do all of your projects have fixed offtakes associated with them? Yeah,
good question. So there is a variety throughout what we do. The T-Mobile case, for example, is a 25-year fixed rate that equates to about a 10% discount to the grid rate. And like a typical commercial power purchase agreement, like a couple of the projects that we have in our operational portfolio are that nature as well. 25-year fixed rate, escalator per year type of a thing. In some of the community solar markets, they're like, for example, New York, it's fairly well defined in terms of what like how that works, and so like or how the credits are valued, I should say. And so again, our typical is to offer a 10% discount off of that. So it does vary a bit, but generally speaking, there's at least a high degree of like long-term fixed aspect to the offtake agreement.
And does each project come with an offtake, or do you sometimes just do some projects and they sell at the market rate?
We would always, by the time that a project is operational, we'd always expect that we would have a full offtake contracted by that time. Yeah, so in the community solar mechanisms, it's kind of like you're offering a commodity at a discount to its typical price, and it's green energy as well, right? So it's really just that kind of a question about working to line that up ahead of time and have that offtake in place. We wouldn't sell at spot is not something that we've done before, and not in our near-term future at least.
All right. And then you referred to the $3 million green bonds that you've recently done. Are those like sort of recourse to UGE itself, or are they there to fund specific projects? Or can you discuss how you structure those green bonds?
Yeah. So that one, so we've issued two types before, project green bond and a project development green bond. So project green bond was against either construction or operational projects and senior to those projects. And then the project development green bond is on projects that are in that kind of those later stages of project development earlier. And then we pledge specific assets to collateralize those bonds at a coverage ratio of 1.5. So, we thought we put together a pretty nice package there in terms of, security and I think a good source and a good use of capital, I think, to fund that type of growth. So, broadly speaking, we use that capital for, the overhead and the development costs and so on of bringing those projects up to construction.
Right. Okay, and let's get to the audience questions here. There are several regarding interconnection delays. Could you discuss that? And what types of things can you do to help reduce those delays, speed things up here, and how is that impacting your business?
Yeah, I think on the interconnection side of things, I feel like generally in the industry, it's being talked about more of late. I think that the way I like to think about it is, it's sort of like going to the grocery store and the grocery store is busy. The lines are kind of long. It's like, the people at the cash register are still working quickly to process those the people checking out. I think that's kind of where interconnection is at right now for the most part. Is, hey, solar is growing very quickly. It's growing quickly in states that haven't had a lot of solar in the past. So you have utilities that are learning to become more efficient, staffing up to be able to process these interconnections and so on. I think from UGE's perspective, like, I really don't like to use it as an excuse. It's like, as a developer, we forecast like 18 to 36 months for these projects to make it through development to a point where they're operational. The reason that it takes up to 36 months as opposed to, say, 9 months is because primarily of interconnection. So hey, I would love it if interconnection was automatic and we could build projects much, much quicker, but we've never been promising people that would be the case. So I think, like, on an overall basis, I think as the industry matures, we're going to see efficiencies gained. Like in Con Ed, or actually in New York State more generally, we have a pretty strong sense about, like, how quickly things will move through these different stages, because New York has more experience than, say, Maine. Whereas Maine, we were in fairly early in that state, but there was just so much growth off of like a standing stop that the utilities and the Public Utility Commission kind of had to put the brakes on a little bit. I think for the most part, I think it's with good intention. So yeah, so I think it's more a matter of us, forecasting accurately, working to be as good as we can on our side, to be ahead of the pack and do things the right way and so on to get through get through as efficiently as we can.
And in terms of the delays from what you had, I guess, originally expected, it sounds like more than a matter of weeks. It's things are being a couple of months longer than you had expected. Is that the rough time frame, or is it more than that?
Yeah. So I'd say that interconnection typically happens in months or quarters, in terms of magnitude. Like the actual interconnection process could take a year or two in some cases, but so delays tend to be more measured in kind of months or quarters or what have you. I think again, going kind of looking at New York versus Maine, both states have requirements of how quickly the utilities need to respond to things. New York, they meet them. Maine, they have not been, and they have not been because of I think, frankly, being kind of overwhelmed and kind of coming back and saying, hey, we need more time. We need to do one more step, and so on. But I think even in Maine, I think that not just for our projects, but I think industry-wide, it is getting closer to a kind of a steady state where it's like, okay, everyone knows the ground rules now. And so here we go. I think that probably by the end of the year, Maine will be like that. And I think we'll probably have several good years that follow that in that state too.
And regarding that, is it delaying your break-even cash flow status? And do you still expect to hit break-even cash flow this year?
So so net. So I think earlier in the presentation, I think that I mentioned that like over the next 12 months, the volume of projects that we're going to start building and are going to build should get us to that point. I think in the grand picture, maybe we're a few months behind where we thought we would have been a year ago, but it's not a significant slippage.
Okay, so a few months, and
Yeah.
that's the extent of it. Okay. What is the value of your backlog and your pipelines if you were to liquidate the projects? Is it still around 70 cents per megawatt for backlog projects, 8 cents per megawatt for pipeline, and around $1.1 per megawatt for operational projects?
Someone's done their homework. I think I think that's probably largely right. I'll add a little context. I think in reverse order, I think operational projects at $1.10. We had sold an operational project a year and a half ago now, and that's what we had netted. I think that the market has become probably only more competitive since then. So I think that that's representative. The 70 cents a megawatt or 70 cents a watt, these should be not megawatt, but
Yeah,
70
okay.
cents a watt for backlog. That's like later stage backlog. So projects that are in, they don't need to be at stage, say 3.3, but projects, well, I think I mentioned in other forums as well that we get contacted very frequently, multiple times a week by groups looking to buy projects. And so projects that have line of sight to getting to NTP, 70 cents a watt is again fairly representative for what we've been seeing lately. That wouldn't be just like signing an initial commitment and saying, hey, all of a sudden we're going to flip that initial commitment. I think that initial commitment is something that maybe the 8 cents per watt type of measure makes sense, like at the very beginning of the type of work. And of course, I wouldn't say pipeline because if we're just talking to somebody and haven't signed anything yet, we wouldn't look to monetize that yet. So anyway, a lot of detail in there, but I think if you back up and look at those numbers that we talked about earlier, the 334 megawatts that we have in various stages of development, you could kind of split that different ways. We think that comes out to a multiple of what we're trading at right now.
Gotcha. And just to be clear, because with the terms, it's $1.10 per watt. So a 1 megawatt project would theoretically be worth $1.1 million on an operational basis. And these are US dollars as well, correct?
Yeah, that's right. That's US dollars. And to that point, so like roughly speaking, very roughly, maybe that project is worth $270. Maybe the cost to build it's $1.60, and so $1.10 is the net that we would capture to use illustrative numbers.
Gotcha. All right. Okay, that's good. All right. Well, someone doesn't like how I'm asking questions. That's all right. How has the regulatory environment changed? How you're looking at project and managing your backlog? For example, community solar in New York State seems to have recently become uneconomical.
So the first thing that came to mind with this question was that the regulatory environment, it's solar in the last few years. So since we started looking at projects, it used to be a very small number of states made good economic sense. New York was one of the first, I think, 2 good community solar states in the country, along with Minnesota. So the thing that's really changed is I know people develop, we're developing projects across the country more or less. And I know people developing projects virtually in every state across the country. So I think what's really changed is that last decade was interesting technology, some states getting behind it. This decade is the decade that solar will make sense everywhere. So I think that's the big thing. I think in New York, I definitely would disagree saying it's become uneconomical. I think that there's like like for example, in Con Ed territory, there was one program, there's another program, and there's there's an evolution of these programs that can change the economics. But like everywhere that we're developing projects in New York State, including in Con Ed territory, is because of the economic case that we see to do so.
Gotcha. What factors give you confidence that you'll be able to convert your backlog into operational projects? And I guess what I'd like to add on to that, what are the things that make them not become projects? What gives you the confidence, and what things like throw them off the tracks, so to speak?
Yeah. I think the thing that gives me confidence to start with is, I mentioned it a bunch of times, but we have over 500 megawatts, and I think that hasn't been updated for a while. I'm not sure what the total is now, of experience of developing and engineering and building and so on these projects. So I have complete confidence that the vast majority of them are going to become good operational projects. And the biggest constraint is just time. It does take time for us to move projects through. And I feel like we're as adept at developing these assets as anybody else that I know within the industry. So that's what gives me the confidence. I'll say too, like our, to go on a little bit of a tangent, our engineering group, it originally came out of us making an acquisition 6.25 years ago, and that group had done years of third-party engineering and so on. So even though we stopped building projects for other developers a few years ago, the engineering group, we continued to have it as a profit center, so it does our own work, and it still has third-party developer clients that we support as well. So I think that we have a pretty good lens in terms of the overall industry. We get hired by other developers for our technical expertise and so on. So I have a great deal of confidence that we're going to see this through.
Right. And what are some of the factors that sort of makes a project not come out of backlog and become operational?
Well, so there's one project I'm thinking about that we had assumed an interconnection cost of X, I forget what it was. Let's say it was $1 million, and the utility came back with an interconnection upgrade cost that was say $2 million, and so the question was, so at that point in time, it's like, well, that upgrade cost is because more capacity needs to be added. So we could decrease the size of the project. So maybe we lose a few megawatts or whatever the case may be, but we continue to do the project. Or maybe we put it on the back burner. Like there's two examples I can think of. One that's on the back burner because of this question. Now the Build Back Better Act is mostly upside. One of the things in that sort of like the prior proposal, and we'll see what comes back of that, is to make interconnection costs eligible for the investment tax credit. So all these like upgrades that I'm talking about, UGE or the other solar developer is paying to upgrade the grid, kind of irrespective. Partly it's related to the solar project, but it's not just a matter of connecting the solar project. Like we are actually upgrading substations and so on for these utilities, and those aren't eligible for the investment tax credit. There's things like that on the horizon that could make a project like that become feasible again. There's one other case where permitting, knock on wood, hasn't typically been a big constraint for us, but there's one project that's on the same parcel of land where there's a real estate development that's tied up in permitting. And so we're kind of waiting for that permitting issue to get cleared to bring that project through.
All right. And we discussed the conversion rates out of your backlog earlier. The question is, could you provide expectations for how your backlog conversion pace will be going forward?
Yeah, I think so earlier we talked about the pipeline stages typically having about a 1/3 conversion rate into backlog, and then the backlog being in that sort of 90% type of range of flowing through to operational projects. And so we don't see reason to materially deviate from that.
Okay. And how long will that 10.7 megawatt project take to become operating once they hit NTP?
On each individual project, we could think about 6 or 7 months on the a more aggressive side, and kind of probably 9 to 12 months on the more conservative side. So yeah, so some of those projects becoming operational just by the end of this year, but certainly some of them into early next year.
All right. And how many megawatts do you expect to have operational by the end of this year?
Well, so earlier, I know there's some rounding there, but we have about 1.5 operating now. We have about 1.5 in construction right now, so that's 3. So we just talked about some of that 10.7 becoming operational this year. We haven't put a specific number out there. I think as those projects hit NTP, we'll probably say, we expect to get this built by X. But those are the ones that are either going to be operational by the end of the year, or certainly in some of those cases into Q1. And then there's going to be other projects we expect to hit NTP or start a construction before the end of the year too. So by the end of the year, we're also going to have a more significant sum into construction.
And just to be clear on terms, NTP refers to what? So everyone's...
Yeah, so NTP is in essence, okay, development's complete, now deployment, you take over and you build this project out. And then COD, or commercial operation, is when it's operational.
All right. For the economics of 100 megawatts, does that include developer fees? If not, what is your estimate for developer fees on that 100 megawatts?
Yeah, so I think one thing that, the very simple answer is that on 100, so if I use some rough math, 100 megawatts of assets, we get every one of these projects appraised by a third party. You need to do that for the investment tax credit. A conservative value on that would be $2 a watt. So call that 200 million USD. I'm going to make the math easier, I'm going to stick with that. And then let's say the developer fee was 20%. The net cash, therefore, from those developer/EPC fees would be 20% times 200 million is about 40 million USD. But that net cash we'd expect as we march towards 100 megawatts of operational projects. Very back of the envelope, but it's in that magnitude, which I'll remind anybody looking at our market cap that our market cap right now is less than 30 million USD.
Gotcha. What are the economics of acquired projects, such as those in Arizona, versus organic growth projects?
The projects that we just acquired, the levered post-tax IRR, those are in the teens. So something that that's what we see them as. The developer of those projects obviously is capturing a developer fee themselves, so we miss out on part of the upside there. But still something that we see as being very accretive to our operating portfolio.
All right. How do you predict inflation and supply chain issues affecting your project build out over the next few years? And what are you doing to mitigate that and manage those risks?
So, and you say over the next few years, I think over the next few years, we have a lot of room for optimism. I think in 2022, solar is the norm, I'd say, in terms of shipment costs are up, shipment times are behind, manufacturing is behind, etc. And it has made for a market that's tighter than we would like. So two important things on that. Number one is that in 2021, none of the projects that we built were above our budget. So even within this environment, we're managing fairly well. The other thing is that in the we jokingly refer to the industry as a solar coaster, and it seems like the industry can kind of often gets in its own ways. And so last year there was this petition on Southeast Asian manufacturers. It came back in a different form this year. So right now, the US Department of Commerce is investigating that. When these things happen, supply chains tend to slow down because manufacturers want to see the outcome of that before they ship again. So, in the next few months, give or take, we could see a bit of a slowdown in shipments to the US again as a result of that. But really, that's all noise. I go back to my interconnection example. It's really on UGE's on UGE here to look holistically and forecast conservatively to make sure that we're forecasting accordingly.
And this sort of my question is kind of tangential to this regarding the solar cell manufacturing. It is highly dominated by Asian suppliers. Yet Trump, I believe, was talking about they were dumping cells and kind of harming the relatively small US manufacturers, but then that raises costs on solar projects, which benefits the US. Is there an initiative right now to sort of to get more production coming out of the US and more tariff issues, or can you talk a little bit more about the solar suppliers and the domestic versus import market for the US?
Yeah, yeah. Across the industry, there's really no material manufacturing in the US except for First Solar. And First Solar only supplies utility scale developers. So for the commercial and residential spaces, there's really no material manufacturing within the US. There's even some manufacturers, including a couple that are technically Canadian. Really, they're importing, in most cases, at least so far, panels from places like Southeast Asia, kind of under a contract manufacturing and putting their name on it. So as of right now, that's been the case. Over the last many years, and I think we all can understand why under the Trump administration this would be the case. The industry has been treated much more with the stick than the carrot, and as a result, the U.S. pays almost twice as much for panels, like between 1.66 and 2 times as much for panels as any other major country in the world. So even with all the growth this industry is experiencing, it's with these elevated costs of panels based on this whole stick approach over the years. Now, Build Back Better, which of course was sunk, there's lots of talk about the Democrats trying to get something through with Manchin here the next couple months. It had a carrot for the first real time as far as I can remember, and that was to provide manufacturing incentives to really spur manufacturing in the US. And our understanding is that it was very much like a carrot versus a stick. We're going to get rid of all these tariffs on importing panels. We're going to give these significant incentives to boost manufacturing here in the US, which would be a major boon for the industry here in the country. So, our fingers are tightly crossed that people can come together on something here, before the midterms.
All right. And just a minor note, solar cell manufacturers are different than the solar panel. Sometimes they're the same, but some people will just do the cells and other people will then assemble the individual cells into a panel for utility or commercial or residential scale. So those are often two separate pieces of the supply chain, correct?
Yeah, absolutely. I think it even breaks down a bit further, but yeah.
Okay. Yeah. And are they doing any panel assembly in America or in Canada, or is that all parts of that supply chain offshore?
Yeah, most of it's offshore for sure. In fact, in the most recent, I guess it was the Trump tariffs, if I'm not mistaken, there was a quota of 2.5 gigawatts that could be imported per year of solar cells, in essence, to spur assembly in the US. I think that the most that's ever been imported in 1 year is like half a gigawatt. Like it's not even coming close to being used because there's just not much of it.
Gotcha. All right. Back to two questions left here. At what point will new capital issuance only be on the project level and non-dilutive, as I guess opposed to at the corporate level?
We're very, very close to that now. I mean, we'd like to think that we are there now. I'd like to be a bit conservative in what I say, but the green bond issuance was in essence non-dilutive capital. There was a very small amount of warrant coverage on that. We went with that, and so I mean, there's a bit of background that some of the attendees might know about, and that is that we had a loan facility set up, a $15 million loan facility that we ended up turning down and deciding to go the green bond route instead because we thought it was a better fit in terms of capital for us. But I think that should show to everybody watching that there is institutional non-dilutive capital out there that can fund our growth. But we obviously just want to make sure that we get the one that's right for us.
Right. And one final question here. Could you provide expectation for how many megawatts you'll have operational by the end of 2023?
Yeah, so the one that we've put out there so far is 100 megawatts by the end of 2024. We haven't put out a more kind of we haven't put out a 2023 number yet. So I'll leave it at that for now, except I will say that two things. As we've been maturing, I definitely understand why it's helpful to our audience to put out those metrics going forward. So that's something that we're talking about internally for sure. And then also the analysts do put out their estimates. And if anybody would like to be, connected to any of those analysts, or, in some cases I might have reports I could share, what have you, definitely don't hesitate to reach out as well.
All right, Nick. And then one final question from me is, let's say through the remainder of the next 6 to 9 months, what kind of news flow should we be expecting? Is it sort of new project wins and advancements of projects, obviously quarterly results, any other types of news that should be on investors' radar to be looking out for?
Yeah, I think certainly there's the year-end end of this month, and then there will be the Q1s next month. So it'll be fairly busy in that front, and I think we'll be announcing our AGM the month after. So, but I think in the meantime, we're developing so much that actually we went from announcing every project just to start doing this kind of quarterly summary. But there's definitely a lot happening with development, with offtake, with battery storage, with advancement into new states, with relationships like the REIT that we mentioned, and hopefully others as well. So I think we should be pretty busy in terms of continuing to update our audience in terms of all the ways we're growing here.
With that REIT you mentioned at the LOI stage, when or if it goes on to a definitive stage, will news like that be announced saying that, yeah, we've sort of got it over the goal line?
Yeah, for sure. At the very, very least, it'll be in our quarterly milestones. But certainly I think we're excited about what we're doing there, and we think our partner on the other side is excited too. So hopefully there's even a chance to come out with a bit more information there.
All right, Nick, we are over an hour here. We've hit all the questions. I'm out of questions. So thank you very much for taking the time to go over the story and answer some excellent questions from the audience. So thank you for everyone's participation. Thanks a lot. And I'd love to have you back in a while as the business progresses.
Yeah, thank you so much. And thanks everyone for taking part as well.
All right, cheers.